Hello everyone, and welcome to the Russell Investments Value of an Advisor webinar. Over the last few weeks, everyone's life has changed significantly, and we are working from home and adapting to new working practices. The markets have become more volatile, and many investors are becoming more anxious. I'm joined today by Sophie Gilbert, Head of North America Business Solutions, who's going to be sharing some best practice and practical strategies that you can implement immediately with your clients. So Sophie, firstly, how does the current market volatility affect investors?
Hi, Mark. It's a pleasure to be here. Thank you so much for having me. It has indeed been a very volatile time for the market recently, and hence for advisors and investors as well. If you think about where we've been since sort of mid-February of this year, and then you compare that to the last, sort of 7 to 10 years of strong sort of upward markets overall globally, suddenly things look very, very different. You're right. And that can really have an effect on emotions of our clients in particular. The way I like to picture that is sort of this market cycle of emotions that you can see on your slide here, where typically, we sort of begin with optimism, and as the markets continue to rise, we move through feelings of excitement and thrill, and then we hit euphoria at some point where we think, wow, the market really only goes in one direction. I've got this, investing thing figured out. I'm good. Other people seem to think that investing is hard, but I've got this nailed. And then suddenly the market begins to wobble a little bit because, as we know, that's how markets tend to be. And suddenly we begin to have that feeling of anxiety, fear, and panic, and at some point despondency set in before markets eventually sort of recover, and then we get back to hope, relief, and optimism and go through that cycle again. And Mark, I would say that in observing investors right now and observing the market and in talking to advisors and to their clients, we're definitely in that anxiety, fear, panic, despondency. A couple of days we'll have hope when markets go back up, and then we all slide back down, or certainly our clients slide back down into that despondency, panic, and fear, anxiety area there. So sort of see that slope coming and going again. It's almost like the roller coaster that gets stuck
Sure.
and slides back a little bit.
Sure. Thanks, Sophie. We've talked about investors, and I guess we should also talk about advisors. What does that mean for them?
Well, this means, in some ways it can mean there's a lot of work to do here, helping clients get out of that slump and certainly avoid any of those feelings of, panic and despondency and hoping not to make any of those bad decisions of, sort of selling at the bottom. As we can see here, that maximum point of financial opportunity actually happens at the bottom, where most clients are sort of inclined to sell at that point instead. So it's a lot of hard work, but at the same time, it's also, I think, sort of the advisor's moment to shine, where they can really make a tremendous difference. And I say that because we've been doing some research at Russell Investments for the last 6 to 7 years on an annual basis on what is the value of an advisor, what is the value of what an advisor brings to a relationship with their client. And we've broken that down into its individual component parts. Let me walk you through that, Mark, because I think it can help, especially in this environment today. So what I'm alluding to is our value of an advisor study, and the component parts that we've identified as being particularly important for end investors and the relationship that they have with their advisor is, one, the sort of annual rebalancing of investment portfolios that advisors do. Now here we say annual. Obviously when it's volatile like it is right now today in markets, we might be rebalancing on a more frequent level than annual. But be that as it may, the point is we're helping our clients rebalance their portfolios, which is important because left to their own devices, we all know that our clients would not do that, right? So I'm putting my advisor hat on. I think the last time that I saw a client say, absolutely, that part of my portfolio that's done poorly for me, I'd love to buy some more of it. And that part of my portfolio that's done really well, absolutely, let's go ahead and trim that. Let's go ahead and sell that position. I think if we all think about our clients and our books of business, I don't know about you, Mark, but it's been a while since I've met that client. What do you think?
Absolutely. Yep.
Yeah, that one's a tough one. So we, obviously us being able to do that for our clients and rebalance the portfolio and sort of have that stoicism that requires, we know can add a lot of value. That's the A component. The B component is the behavioral mistakes that we see investors typically make. So that, buying high and selling low is one of those examples, for instance, of mistakes that clients make. But there's a whole host of others. There's over 200 investor behaviors that neuroscientists and psychologists and a whole bunch of researchers have identified in clients, in investors, that advisors help manage day in and day out. So that's the B component. The C is the cost of basic investment-only management. So here we're thinking about, our clients do come to us for portfolio management as well, and for putting together a portfolio, for selecting funds, and so putting together an asset-allocated portfolio and maintaining that over time. That is all that cost of basic investment-only management goes into that, and obviously we get compensated for that. Interestingly, we get compensated less and less for that over time as we've looked at the study over the last 6 or 7 years, but that is still an important component of what we offer to our clients. And then lastly is the P, the planning and other wealth management services that we provide to our clients. So here I'm thinking all of the quantitative and also the qualitative elements of a relationship that we have. So it's not just putting the portfolio together, but it's also monitoring it. It's also looking at, what are their goals and their circumstances and their preferences. What does that mean in terms of a plan? How do I build a portfolio that's aligned with that? And then how do I continuously monitor and communicate with my clients to ensure that that those goals are still what they are and we don't need to make a portfolio change. So Mark, that's sort of the overall formula, and over the years, every year, we actually update the values of that because it can be helpful to see, okay, where is the relative importance and how much does my value equate to? Are you ready for the reveal, Mark?
Yep, absolutely, Sophie.
So the reveal is here. We'll put this up on screen. So here we can see that the total value of the advisor is estimated at about 3.57%. We can see that the majority of that is actually coming from that behavioral guidance that we provide to our clients. Right after that is the planning and additional wealth management services that we provide, but the bulk of the value of that 3.57% is really coming from that behavioral mistakes. And so that's why I feel like a period like now where clients are really having a hard time struggling, what should I be doing? Should I be doing this? Or maybe actually they feel very confident about what they're doing, but we know with equal amount of confidence that that's probably not the right decision. That's where that behavioral component comes in, and that's why I believe that really now is our advisors' moment to shine, because helping clients avoid bad mistakes in this behavior side of things can really change the trajectory of their future.
Sure. Thank you for that, Sophie. So that's 2.23% out of the 3.57%. That's a significant amount of value for an advisor. So in today's environment, what sort of behaviours should advisors be looking for in particular from their clients, and how can they manage those behaviours at the moment?
Yeah, absolutely. I think that's a great question, Mark, especially because, as I mentioned, there are over 200 behaviors. So I think I wouldn't try to identify all 200 because otherwise we'll never make any progress in our review meetings. But I think that there's 3 in particular at the moment that I would keep a close eye out for, just based on the market environment and based on what we know about human psychology. Overconfidence, hurting, and familiarity are 3 that I would be paying close attention to in my client meetings right now and client interactions. Let's just go through each of those briefly in turn of like what are they, what might they look like when I'm sitting in an office or on the phone, and hopefully with some sort of video capability so I can actually read my client's body language. That helps a lot. and then how can I manage that behavior? So starting with overconfidence, that's that human tendency to sort of overestimate our ability to successfully achieve tasks and perform tasks and do things. So for instance, if you ask regular people, are you an above average, average, or below average driver, depending on where you are in the world, there's always a majority of people that will raise their hand and say, yes, I am an above average driver. Now, of course, Statistics 101 teaches us that that's impossible. Depending on where you are in the world, that percentage of people that claims that they're above average will increase and be larger. But generally, there's a human tendency to overestimate our ability to sort of manage things. Now, when you think about that from an investing context, what might that look like? That can often sort of lead to people trading too much. Oftentimes people think of overconfidence as being a problem when markets are going up, right? That sort of tendency to want to buy as markets are going up, even if we're overpaying. But there's an equal amount of overconfidence that can happen on the downside as well. And that comes from the fact that we want to avoid losses and we prefer gains. We get hurt twice more by losses than we do by gains emotionally. And so there is really this overconfidence on the downside of markets as well, where clients become very persuaded that, I absolutely need to sell. So as they're hitting that panic, anxiety, and fear and despondency point, that overconfidence can really begin to come out as well. So you want to be careful about that. How might you be able to manage that in your actual, sort of client interactions? Here, it can be helpful to have your clients sort of check their impulses and their rationale, and to have them seek perspective from others, so from you before making any decisions. Oftentimes, what I like to do in this instance, although it applies to all three scenarios as well, is to sort of have the client stop for a minute and think about, what would my life look like if I was right about this decision, if I was right about selling this particular position or something in my portfolio, and have them sort of answer that. Then second, ask them, what if I was wrong about my decision? What would the impact and the implications on my life and on my family be if I was wrong about this decision? And have the client answer that. And then lastly, I would ask, have you ever been wrong before? And then just pause. Because what we're trying to do here is we're not trying to stump the client or show them up or anything, but we're just trying to help the client stop and pause and think before making a decision, so that their sort of rational part of their brain can really step in and start making some decisions, as opposed to just their quick thinking, fear and flight brain that is operating at a very high pace at the moment because they're fearful. So that would be overconfidence there. For hurting, that's our tendency to sort of copy what everybody else is doing. Because we're humans, we tend to find comfort in the crowd. It gives us comfort to be like everybody else. Millennials nowadays have sort of given that a new term, and they've given it an acronym, FOMO, the fear of missing out, right? That's what all of this is about. So for instance, fidget spinners, you can see the image here, were all the rage a number of years ago, and now nobody uses them anymore. There's a whole bunch of other fads like that we can all think of. Well, this happens in investing too. And how might this look when it appears in investing? It can be that classic buy high, sell low sort of mentality. And we can see that very clearly in the data. We have it available in other presentations. We didn't want to bog you down with it here today, but we're happy to share that, where you can clearly see what was the performance of the market and what were investors doing. Were they investing in the market or were they exiting the market? And there's a very clear correlation between when markets go up, people are investing in the market. When markets go down, people are redeeming on net from the market. Now, how can that be managed? How can we help our clients avoid that behavior? there it can be helpful to remind them of what were your long-term goals and what are we trying to accomplish here. And we had a disciplined process going into this, right? We had a plan, we had a financial plan that we put together. We put together a portfolio that was aligned with that. So let's get back to basics. Let's get back to our plan and look at, yes, the markets have changed, but have our goals changed? Have our circumstances changed? Have our preferences changed? Of course, we all have a preference for less volatile markets, but we know that part of investing is sort of dealing with volatile markets. What else has changed in our plan? And if nothing else has changed, then actually not making any changes is also an active decision. So we don't need to make any other active decisions. We can simply and very legitimately stick to our current plan. Absolutely acknowledge our emotions and acknowledge that we're not feeling the same. But if the facts haven't changed in our plan and in our goals and in our circumstances, then it's better and safer just to stick with our plan and protect that plan and that portfolio. So that's sort of herding and reminding clients, okay, the bigger perspective. And then lastly is familiarity. That one's going to be kind of common at the moment as well, where we tend to prefer whatever we're most familiar with and whatever is most sort of well known to us. So what might this look like in investing? Often it can look like having an overweight to our home country. No matter where you are in the world, everybody has a bias towards their home country stock market index, regardless of the actual relative size of that stock market index and the overall market capitalization. So you see that in the U.S., where the market cap of the U.S. represents close to 50% of global market cap, and typically investors in the U.S. have about 87% of their portfolio invested in the U.S. Similarly in the UK, which represents between sort of a much smaller proportion of global market cap, and you see similar levels of between 80s and 90% of portfolios typically invested there. You look in France and Germany, and Japan, all in Canada, everybody does this. It's very natural. However, we know that that can also have implications, right? We could, forego good investing opportunities outside of our home market because we're too concentrated in our market. So how might we be able to manage that? Because that can become very prevalent at a time when people are fearful. We can help remind our clients of the benefits of diversification and of, kind of casting that wider geographic net. It can also be, sort of wider industrial net can be very helpful. So I think right now, Mark, these are the three behaviors: overconfidence, herding, and familiarity, that I would be really careful about in helping identify and then also manage those behaviors in my clients.
Thank you, Sophie. That's fascinating. And I'm sure some of the insights and best practice that you're giving in those sort of three groups of behaviors will help our listeners have far more fruitful review meetings and initial meetings with clients during that time. I'm just thinking about the resources for this to support some of those conversations that advisors may be having with clients. Can you just highlight some of the areas?
Yeah, absolutely. We've done a lot of thinking about this over the years, but especially right now in the current environment, since we are dealing with so many different facets coming together. You mentioned market volatility hitting, and then of course, because of COVID and coronavirus, we're all working from home, right? We're doing this from our homes in Seattle and London at the moment, and doing this conference call here instead of in our offices, because everybody is working from home, and so that adds another layer of insecurity and of anxiety and fear and potentially panic for a lot of clients. And so we want to be mindful of that. So I think that going into our reviews this quarter, right, statements are being sent out. We're going to be getting those phone calls from clients soon. We might not have gotten a lot of phone calls from clients quite yet because they've been so busy figuring out where do I get all of my groceries that I need? How do I become a fourth grade, preschool or homeschool teacher suddenly, as well as keeping my job and, figuring out the day-to-day life and how that's different suddenly. But once those statements begin to come in, investors will probably sort of wake up to, wow, there's also been a lot of volatility and that has had implications on my portfolio. So be prepared for those calls coming in, as well as obviously the standard reviews that we're going to prepare to do here because it's quarter end. So I think what I would suggest is putting together a framework that sort of goes around what we're calling the 3 Ps of an effective client review. So the 3 Ps being providing perspective to my client, reminding them of our process, and then also exuding sort of poise. And I can go through each of those a little bit in turn, but providing perspective, that's all about giving our clients perspective on what have been the world events that are going on, what is the latest guidance on sort of the health side of the equation at the moment, as well as what has been going on in the markets. What is the news versus what is the noise in the markets at the moment? What do I need to be paying attention to? What do I not need to be paying attention to quite as much? And also some perspective on what is the value of having an advisory relationship right now and of working with a trusted advisor like me. So there I would think again about some of that value of an advisor, that A, B, C, and P, right? That rebalancing, that behavioral guidance, that providing the portfolios, that cost of portfolio management, and also the planning. Providing that language to our clients and reminding them of that value and giving them that perspective. Second, in terms of process there, that's all about reminding them and digging a little bit deeper into what are their priorities and how do their priorities, how are they reflected in their portfolio and also in their plan, in their financial plan. So reminding them of that wealth management process that you went through initially and potentially taking them through it again, just to make sure, right, do a rediscovery of our clients to make sure that we are crystal clear together on what their priorities are right now. Have they shifted or have they not? If they have, then does that warrant any changes in the financial plan, which then would potentially have implications for the portfolio that we've put together, and maybe need to change that. Or if the goals haven't actually changed, if our priorities haven't changed, then we can probably operate with the existing financial plan and also with the existing portfolio. The portfolio, we may need to tweak it a little bit. We might, for some clients, want to de-risk it a little bit, but generally speaking, the process there is just giving the client that comfort of the continuity of the process that we have always been following applies right now as well. Let's just remind our clients of that. That consistency can be really comforting to clients right now as everything else in their life feels like it's operating in an earthquake. And then lastly, poise. That is sort of, that reassurance and that calmness that we can provide to clients through the, consistency, but really through asking them questions, right? Sort of going into the meeting with that openness of mind where we're asking them open-ended questions, we're truly listening to them, and we're empathizing with them. So it's not just about, providing them with a bunch of jargon and a bunch of insight, but it's really giving them the space to be heard and to be listened to so that we can truly understand what are their priorities and have them be able to, feel calm again. So those are sort of the 3 Ps that I would be thinking about right now going into the client reviews, Mark.
Thank you, Sophie. And I think that provides a really useful context for those valuations as they go out and inevitably some of the calls that start coming in and really support people on how they can have those conversations with clients in a really meaningful way.
Yeah, absolutely. I think the other thing that I would think about from an advisor's perspective, the 3 Ps were sort of more focused on that client review. If you're thinking about your agenda, how might you want to structure it and sort of lead that meeting. There's also a market volatility checklist that I would think about that we've with an acronym GUMPS. So for anybody that has watched the movie Forrest Gump, this might has nothing to do with the movie, but the acronym might help remember what are we trying to accomplish here. But where the G stands for gather your thoughts. And this can be a checklist that you can use every single day, or any time that you're feeling, okay, I'm starting to get, some of this anxiety and this fear and this panic can be a little bit contagious. I need to sort of protect myself from that, because if I'm feeling that way, I'm not going to be any use to my team or to my clients, and maybe even to my family and to other people in my community. So what can we do to protect ourselves from that? First is really gathering your thoughts. That's the G. The U stands for understanding your client's concerns, right? Again, that's that ask and listen and empathize. Where are they coming from, so that I can really tune into their emotions? Think of that market cycle of emotions that we showed at the beginning. Where is my client plotting on this graph at the moment? What might that mean about where they might go next? Where have they been already? What zone are we in here, so that I can really tune into them? The M stands for measure your words. So I mentioned when we're sort of talking to our clients around and trying to do that in a poised way, that also means cutting out the jargon, right? Cutting out all of the technical words that we tend to use amongst each other and ourselves, right? Because we're all sort of into this industry and we read everything, but most investors are not. So making sure that we're being careful and not using jargon and just speaking in plain English so that our clients can really understand. The P stands for protect the plan. A little bit like doctors, their sort of first mantra is first do no harm, right? For us as advisors, it's protect the plan. That's what we need to make sure is always going back to the plan. And then S stands for staying focused on what you can control. Again, there's a lot that's unknown at the moment. We don't know how long we'll be in this situation. We don't know how long we'll be working from home. We don't know how long schools will be closed and all of that. We don't know how long the market volatility will continue. But there are a lot of things that we can still control, and it can help our fear and anxiety and also our clients if we can help them and ourselves stay focused on what it is that we and our team can actually control. And again, that comes back to that wealth management process that we have, right? Being crystal clear on the priorities of our clients, making sure that we know what their goals, their circumstances, and their preferences are, that they have a plan that is aligned with that and a portfolio that aligns with the plan, and just focusing on those things.
Thank you, Sophie. That's really interesting. And I think that GUMP's checklist really provides a very good track to have those client discussions when those end of quarter reviews start to hit their mailbox and they start to open them up and then wonder how their life is going to change and what's happened to their portfolio. GUMP's a really good way of looking at it. I'd just end with the final box you'll see on the presentation, leveraging your resources. These are the resources that are available on the Russell Investments website that will help you in all that we've talked about today. First point I'll mention is the Managing Through Market Volatility webpage. Within this webpage, there's a number of resources available that includes the Value of Staying Invested tool, which has been very useful for a number of advisors who've been able to show clients the value of staying invested during a volatile period, as well as what the pattern of returns may look like, and also during a client review meeting support the idea that sometimes the pattern of returns in the markets goes down as well as up. The next thing we offer is a Market Week in Review video. You can see that at the end of the week. It's available. It provides useful market commentary, and as does, finally, the Russell Investments blog. The Russell Investments blog contains some very useful generic information, which looks most recently at bull and bear markets and how long they've lasted, but also the type of information that helps you have those discussions with your clients and also keeping them on track during that period. So if you want that information, please sign up for the Russell Investments blog. We have a lot of useful information besides that, so please feel free to contact your usual Russell Investments contact or go to the website and maybe request a meeting. I'd like to thank you for your time today and thank Sophie Gilbert for her insight and sharing that best practice, and good luck with those client reviews. Thank you.
Thank you.